Welcome back, everyone, to another episode on Living Your Greatness. And today I am joined again by Michael Oliver. And for those of you that don't know Michael Oliver, he doesn't just follow the prices, he studies the hidden momentum and patterns driving the markets. So, Michael, it is a pleasure to have you back on today. How you been?
Good to be, Ben. Good to be back. I've been fine. I'm on the edge of my seat in what I think is about to happen. And therefore, it's a happy edge of the seat, not a nervous one. It's a sense of high degree of confidence in our assessment, especially what's going to happen to silver.
Yeah, no, I've definitely noticed that you're very, very excited right now. In fact, I know you believe that there's something coming for silver in terms of it becoming a monster right now. So if you could just kind of kick off this conversation with why you are banging the table so hard right now when it comes to silver.
Well, if you look back at, we ran studies over the last month in our weekend reports where we looked at copper, for example, back to 1980s, 70s, 80s, 90s, 2000, 2005. Copper was in a dead range, or in a range. It's where it lived in. It was this reality, up and down, just like sort of silver's done for 50 years. $50 down, $50 down. Now we're tangling with 50 area. But when copper came out of that range in, I was late 2005, early 2006, it quadrupled in price in a couple quarters. And hey, new reality. It didn't incrementally go from 1 to 4 level. Okay. It did it in a couple quarters. And then, yes, it's a violent sell-offs, but at levels that are now 4 times the height, 4 times the average price of that decade, multi-decade range that prevails in 80s, 90s, 2000, et cetera. And then we looked at lead, exciting market. It did the same thing. It was in a dead range, 70s, 80s, 90s, 2000. And in 2007, it broke out its old reality, and it quadrupled in price in a couple quarters. Not coincident with copper. That was a year prior. Lead did it. And then lead has lived in a zone of reality, a new level that's 4 times the price level of that zone of reality back then. Okay, now look at gold. The mama market was silver, monetary metal. Gold made a high at 850 in 1980, made a high at 1920 in 2011. It was up in the mid 4,000s. Okay, what's silver done? 50, 50, 50 area. What's going on? What's restraining it? Well, it's not an issue. There are arguments that are solid that it's been manipulated. We know there's even been some convictions in that regard. But we also know that when you try to distort reality by artificially suppressing something, talk about even when governments try to do it, because they can't withstand ultimate market pressures. When it unleashes in a tantrum. Now, we all know in hindsight, investors with any maturity do, that markets make bubble tops, like the stock market, like the .com or the mortgage crisis was building from 2005, 6, 7. Market ignored it, didn't care. And finally, when it cared, it fell apart. But it ignored reality. And therefore, another bubble top, or 29 was a bubble top, 23 to 29, then collapsed 80% by 1932. We all know in hindsight, markets make excess on the upside, but they also make excess on the downside, where maybe a market goes down hard, but maybe too hard, and it lays there dead for a couple of years, and investors just pass it by because, heck, it's nothing going on, right? Just ignore it, forgetting, of course, that it's dirt cheap. And when it wakes up, suddenly it's like a thunderbolt. It's not like a little creepy crawly thing. It's quite common. Well, we're arguing silver's in that same position of moving into a new reality. It has all the reasons. Plus, we have a bull trend. Silver's in a bull trend. Gold's in a bull trend. And when we measure certain other metrics, not just look at the simple price chart, which everybody does, and every time there's a $3 drop in silver, it's the end of the world. I buy into them. Okay. If you measure, for example, the monetary metal mama, gold, versus the S&P 500, In 2011, when gold peaked, it came down in price, and it really came down in 2013 into 2015. It was 2013 was its real bad year. And during that time, if you measured gold owning it versus the S&P, you were a loser. Gold was losing value to the S&P. But starting at the 2015 low, when gold made its low at $1,050, if you plotted the spread, divide the front month COMEX contract of gold into the S&P, and plot it month by month, where's that spread? What percent of the S&P price is gold? You got a chart, okay? You could draw lines sideways for the last 11 years, in fact, going back to 2014, where relative performance of gold has really been on either side of that low we saw in 15. But there's also on that chart, over 11-year period of time, you can catch 1, 2, 3, 4 different highs where gold rallied on a relative basis to the S&P, which meant also gold was rallying price, but on a relative basis, it shows up on the chart. And you created a perfect trend structure, almost flat, slightly declining structure on the spread that says if you get above this line, you're breaking out versus the S&P. Right now, we're at levels. If you close the month today, you're breaking out. Okay. Now, when that spread breaks out, again, remember, it's an 11-year wide base. It's saying something just began. Asset class movement from gold out of the S&P is just commencing. You just crossed the starting gate. So if anybody who's arguing, oh, gold's too old or it's RSI is too high, that spread chart says you don't even know the game is just beginning. Massive asset class shift. Similar structure exists on silver versus gold, where we know that silver is still in that range and gold is going up, multiples. When you plot a spread on that, let's say go back to 2020, for example, when silver had an explosive up move, remember, starting about in March through late that year, silver doubled in price, gold went up about 40%. So silver outperformed gold. But since that peak in early 2021 for silver, its relative performance is staircase down. And it also built a flat range top where there was the spread had a rally and bumped the level, backed off. Silver rallied versus gold, stopped at a given level, backed off. You're now pressing back toward that level for a third time, meaning the spread chart has a breakout level not far above. And if you cross that level, divide an ounce of silver into an ounce of gold, express it as a percent. When you cross that level, that spread chart says silver's going to beat gold. Okay, put those two contexts, the two things together. Gold's about to shift out versus the stock market. By the way, gold's already broken out versus the Dow going back 10, 11 years and versus the New York Composite, which are broad indices. They're not front-end loaded with 2, 3 AI stocks, okay? It's already broken out versus them. We're waiting on the S&P breakout versus gold versus that. But when that happens, it looks like the silver-gold spread is also on the cusp of a breakout. So MSA is watching those two spreads most importantly. I think they're not only important if you're in the gold-silver markets. They're important if you're looking at major asset category shifts. Like, should I still hang around in the S&P or should I move more money to gold? Was it Morgan Stanley or Goldman Sachs, a senior theoretician, came out with an opinion a week or so ago that said portfolio notion of 60-40, stocks, bonds, should now be 60-20-20. Stocks, bonds, gold. There's a big admission, big statement. Probably more likely it should be 60% gold, 20% stocks, 20. Okay. But even institutions like that are starting to recognize something's going on to make that kind of statement, to break a norm that's been around for decades, 60-40. And there's other factors out there outside of gold and silver and outside of the stock market itself that will help spark these events. And we can get onto that as you want to. Anyway, that's our main thesis right now. Watch those two spreads, because when they both break out, it's starting something. It's not ending something.
Michael, I appreciate that explanation. And I'm curious to ask, if silver hits three digits, what would this mean in terms of gold? Right now it's currently trading roughly an average of 4,000.
Yeah.
What would that mean for gold from here?
Well, if again, we pointed this out many times over the last year that if you go back to when gold was legalized by the government in 1975, and you look at the prior bull markets that occurred in that 50-year period, one took us from a low in the 76 low was about $103. It dropped from 200 down to 103, 75 to 76. And in the next 3.5 years, gold went up eightfold, $103 to 850. Okay. 1980. Then in 2000, 2001, gold was bottoming at around 260 repeatedly, quiet bottom. Wasn't going back to $50 again, back to 100 or even back to 200. It was at 260. Okay. When it turned up, it went to 1920, took it a decade, longer time span, another eightfold move. Okay. Now we have more fundamental dynamics now and technical dynamics than we had either of those times. So to expect it to just go an eightfold move is probably a mistaken notion, but even go eightfold means gold's going to go in the mid 8,000s. Why? Because our bear low was 1,050. We're only halfway logarithmic dimension of those prior two bull markets. So everybody says it's overdone. It's only half as much as those prior two bull markets when you do a ratio scale, price to price advance. What percent gain did you make? So gold is only halfway, even just getting to the norm of an eightfold move. And I doubt it'll stop there. But even if you have an eightfold move, I mean, that's doubling from current levels. And that would shake the world as well. And no doubt there would be reasons for that people would look back and say, aha, now I understand why, And some of those reasons are starting to come into place right now.
What do you think right now, Michael, is holding back the everyday investor from seeing the truth right now in the markets?
Front-end loaded indexes. So you say, oh, the S&P was up today. Well, was it up or were 10 stocks up? And everybody acknowledges now that, yeah, it's very narrow and that's not good. But on the other hand, it doesn't seem to stop it. So I'm just going to be a believer. So the old rule of when the market gets too narrow, you got to get worried. That's been around for a while. In fact, it's been around for 6-7 months now. Because if you go back and measure like a spread basis, divide the price of, let's say, XLS, the financial sector, into the S&P, and you'll see that when we made our highs in late 24, early 25, in the S&P, in the financial sector, in the AI stocks, everybody was up there happy, okay? And then we had the April drop, and then everything took off again to the upside. Even the financials managed to nudge out the high they made early this year. XLF got above it. Right now, XLF's trading about where it was early this year. So the S&P's is 6,700. In January, February this year, it was 6,140 something, I think it was. So we're still about 10% above the yearly high. But financial sector's back down to those highs. And when you run a spread chart of, let's say, the tech sector, or especially weighted by AI, like NASDAQ 100, or run XLK ETF, whatever, and plotted against the S&P, that when we turned up again after that April low, which unfortunately was headline-based, and they're never good to have a sell-off that's headline-based. It doesn't work. You went up, made new highs, but the outperformance of those sectors was clear. The spreads exploded, meaning long tech, short the S&P, made a lot more money. But XLF, when you plot it versus the S&P, did this. After the April low, it kept going down in spread. In fact, the XLF right now is about not far above the lowest readings it's seen in 3 years relative to the S&P. So not only is there a divorce in the leadership and the broadness of the market, but the internal performance of certain key sectors few people are looking at is pukey. It looks terrible. In fact, you go back to 2007, you see the same thing. The market made a high in July of 2007. It had a sharp drop into August. S&P now. Came back up in September. Fed cut rates. Surprise. Shot to a new high in October. Tech looked good then. Financials were on a relative basis imploding. In fact, on a net basis, they were going down. But nobody paid attention to that because the index itself, S&P, which obviously was front-end weighted in to some extent. So there's a lot of distortions here that are being hidden by the way that NDX, NASDAQ 100, or the S&P are built. But the other sectors out there, commercial real estate, financial sector, something's wrong. They don't know what the S&P is trying to tell you. They know something else. And people are ignoring it. And we're getting net. We measure price versus momentum. We measure versus like a monthly price action versus a 3-quarter moving average, which is like almost the same as a 200-day average. But we plot an oscillator. We don't just look at the average, getting above or below. It's not important sometimes. But we plot the oscillator. And for example, XLF, financial sector, is literally a couple percentage points above levels that will break its long-term momentum floor structure that will indicate down. Within that sector, we're watching large symbols that nobody's watching, like Visa, MasterCard. They broke major structure at the close of October. They're down pretty hard this month. Nobody's noticing. Visa made a deal to accept crypto recently. We think the crypto market, Bitcoin especially, is at potential crash, has broken levels that we would define as potential crash structures. Did that up at 108,000 on one of our metrics, and they did it just below 102,000 via another metric. Right now we're trading 95,000. Our projection is Bitcoin, whether it does it faster or over 6 months, is likely to go at least to 60,000. That would wipe out a couple years of longs, late coming longs, which is where most of them came. And a lot of them are leveraged. And now with crypto, the problem is the financial community. There are a lot of companies that are involved in crypto that weren't involved 5-10 years ago. And suddenly they're up to the hip in commitments to crypto one way or the other, including Visa, which allows, the crypto payments. So we're watching things on the side other than, let's say, NVIDIA and Palantir. They look vulnerable too, but on the other hand, the ambush is likely to come from things that people aren't thinking about, like a Bitcoin drop destroys a lot of speculative money, which is embedded elsewhere and connected to various companies too. They could suddenly have a problem, headline off to the side. What do you mean Visa's collapsing? What do you, et cetera, et cetera. So those are things we're watching, and it's those type of events, ambush events we call them, that have happened before in prior bull markets where suddenly it's not where you think it is. You get kicked in the gut from something on the sideline, but it has big consequences. And I think those are the type of dynamics that are shaping up for something soon. I'm not predicting a broad market crash. I'm predicting we already think we're building at top. We thought we were building it since January. The fact that it made new highs since then does not change our vista. From an investment grade point of view, the stock market is topping. Price doesn't know it yet. Momentum does. But when those things change and the public then gets hurt, if you're an investor right now, or let's say you're about to retire and there's only one thing you're smiling about. It's not the fact that your credit card is maxed out, or that you're delinquent on your mortgage. So certainly you don't smile. But, my retirement account, if it reflects, let's say, the S&P, hey, it's up on the year. Great, that's great. If you take that away from those people quickly, like 2-3 months, you drop 20%, not crash. And then 6 months later, you're 30-40% off that. All of a sudden, there's no smiles. There's nothing to smile about. And that's when emotion comes into play. And it's that kind of thing that creates dynamics. And I think the monetary metals know it.
Seems that you've also been able to explain that there's a lot of wealth that will be transferred. There's been a lot of attention, I would say, in terms of speculation, in terms of Bitcoin, as well as AI stocks, meme stocks, maybe even tech stocks. I'm curious to know from you, when do you think we'll see more of a transaction or transition?
Yeah, I think when it happens, it will happen soon. and suddenly. In other words, you're not going to incrementally slip through things. Well, even Bitcoin, for example, a couple of months ago. And by the way, Bitcoin, if you lay a monthly price chart of Bitcoin on top of a monthly price chart of NASDAQ 100 and go back, let's say, to 2021, almost month by bloody month, they peak and they bottom at the same time, and they have the same behavior. In fact, we ran the charts and took off the price scales and the names on the charts, so you couldn't tell the difference. But suddenly there's a difference now. And that is Bitcoin made a high, what was like 2 months ago, 127. All of a sudden you're 95. And NASDAQ 100 is still tangling around, not on its highs, but close, So it hasn't responded yet. But that correlation's too solid. And what it tells us is forget the fundamentals of Bitcoin or fundamentals of the NASDAQ and AI. There's a speculative fever that inhales and exhales simultaneously in both markets. It's like they're the same guys buying both, selling both. And when you get to the point of margin calls, and I understand a lot of crypto longs are margin, that could ripple into other things. It's those kind of dynamics that when they happen, they could unleash pretty quickly in a way that's surprising, not arm wrestling style, but a sudden jolt that spooks folks, justifiably and financially hurts them. Coin's already underway. It's broken too much stuff. And these other stocks within the financial sector or the financial sector broadly, its performance versus the S&P looks terrible, but nobody's paying attention to that. And when these things hit, they hit suddenly. So it's not like it's going to take us a year to prove the point. No, all of a sudden you'll go from March to April, you collapsed, unfortunately, with headlines. You don't want to sell a market when there are negative headlines. You want the negative headlines to come later. You want the drop to be sort of unexplained. You get the point. And so sure enough, when they reversed the headlines and Trump said, okay, 90-day pause, that's when you made the April low and we're not okay on the tariffs. Anyway, so now we're getting good news. That's good. Government shutdown is over. Oh, that's one dark cloud removed. And we got to deal with China that pushes things off, quite a bit in time. So that's off the horizon for now, at least. So, hey, we got blue skies, right? Let's go down now with blue skies. That's what confuses people.
This makes me want to talk about with you, if we think about that, even in the last 2 years with central bank buying, gold has done extremely well, and it's obviously supporting its backing tremendously from a fundamental standpoint. But what's been interesting to see is that these companies within the mining space, their balance sheets are looking healthy, in fact, more healthy than ever.
Yes.
So how will this maybe bring more attention to the general investor?
Well, you can see even over the last few days when they've whacked silver a couple of days, thinking, if the stocks go down, you got to sell silver. Well, that correlation is like 1 in 10, okay, going through history. It's a teaser, okay. Anyway, right now the S&P's down on the week and silver's up a buck, let's see, $2.50 or so, okay, for the week. Closed last week around 48, remember. We're going to settle today at 50, 67, I think, something like that. Anyway, last few days, the miners they've gone down. They get hit early, but then and so you look over and gold's down 1% or 2%, silver's down 2 or 3, and the miners are down 1 or a half. Something's happening there. And spread-wise, we know why, because back in April, we put out a report showing the relative performance, a spread chart again. Divide GDX into the price of gold. Plot it month to month. And there was this downtrend channel that was so well defined. You pop through it and whoosh, gold miners went electric. They doubled. It went from like 40 something on GDX to 80. Okay. Right now you're in the mid to upper 70s, I think. What caused that? Well, the spread broke out, and that indicated money is now flowing more into the miners than it is to gold. Now, why is that occurring? Okay, there's one good reason, and that is, one, you cited the fundamental. They're making tons of money. I mean, the cost of production is way down there, under 2,000 or something, 1,500. And nobody's acknowledged that. So there's this pent up, sudden new reality, like we're talking about, can happen to silver. There's a new reality, and they double quickly. No headlines, just an old reality was wrong. Okay. Their spread situation has another breakout level that if you can clear it, and we're using XAU versus gold because we can go back to the 1980s on it, and it's in the 7% zone right now, maybe 7.5% of the price of an ounce of gold. Divide XAU into that. Back in the 1980s, 2000 to about 2008, XAU used to be trading in a range where its price was 17.5% to over 30% of the price of gold. And it was a zone of relative performance. 2008 onward, it collapsed, especially during the bear market in gold and the miners, 2013, 14, 15. And went all the way down to 4%. I mean, something that was living 30% to 17.5 went to 4%. You talk about undervaluation, the miners to gold. Since then, for 10 years, they built a range. And we're now approaching the upper end of that range, not the breakout I defined before, which occurred back in April, but a bigger, broader range. And about another percent up in XAU, actually less than 1% gain versus gold. It's going to blow through the top of this decade-wide relative performance rate. When you look at that chart, there's nothing between that breakout level, just above 8%, and the next resistance, which is that multi-decade range with the lows at 17.5. I mean, you could go from 8 to 17.5 with nothing in your way, technically. I mean, you could double miners versus gold. And I suspect that's likely to happen. And that would indicate one thing to me. One, a lot of asset managers don't buy silver or bullion or silver futures. They buy miners. And when they look at the fundamental you just cited, how much money they're making, their jaw will drop. A lot of them are very ignorant people, okay? They weren't aware of this before. But when that spread breaks out, that's going to indicate to me that a massive flow of the money that's going into the gold and the monetary sector is going into the miners, as opposed to gold and silver. Yeah, they're going up. Silver's going to go up more than gold, probably more than the miners even, definitely. But the miners are a better place to be than gold at our assessment.
For investors that have been very patient in terms of maybe they've been in the market since 2015, they can't almost believe the prices even today. And, some of these investors can't help but play defense. They're nervous with everything else in terms of inflation and in terms of maybe a monetary reset. It's been clear to me that you are so bullish for the next 6 months in terms of the prices of silver and gold. And you've already explained today many reasons why there's so much support.
Mm-hmm.
If they are nervous right now, what would you tell them?
Well, I would say look at the context. Again, gold's only halfway the same metric move that it made twice before in the last 50 years. So figure that in. Even just to match those, you go 8,000 plus. Okay. Silver versus gold is very depressed historically. And it looks like it's on the edge. Technical breakout versus gold, which will get it back to normalities and probably to some high levels, which we're 1.24, 1.25% of the price of gold right now. Divide an ounce of D silver into gold. You end up at 1.24, 1.25. There's a spread breakout above 1.3%, not far above it. When you break out of that, that's when I set the clock on that 6-month issue. Not now. I'm waiting for that spread to break out. When that occurs, I'm arguing that in the next couple quarters, give or take, you're likely to see silver go berserk. Gold's going up too, but silver go berserk, net price-wise and relative to gold. Catch up for old realities they've been stuck in. Unjustifiable. It made a mistake. Maybe it was imposed from above, but it made a mistake. And when it wants to reprice itself, it won't do it gently. It'll do it in a thunderbolt. I think we're on the cusp of that. The other thing to watch is gold versus S&P. Again, we put these in our Every week we issue these updated charts. When those two things break out, I pound the table and say, if you're an investor, shift your mentality out of the stock market into gold. Even if you don't think the stock market's going down, fine. Okay. Gold's going to beat it regardless. Because when that spread breaks out, it is a huge technical event. And nobody's talking about it. All they're talking about, gee, gold's overdone. You don't know what's overdone. These other factors out there, like you mentioned, monetary reset. Fiat currencies have not worked. They've created ongoing debt, ongoing monetary growth. Government uses these pieces of paper to do what they want to and print the money. And the consumer, the average guy, has to pay for it in the sense that the dollar in his pocket 10 years ago is worth half what it is. When your dad built a house, it was your granddad built a house, $4,500. Your dad built one, $45,000 medium home price. Now it's $450,000. That's what I mean by degradation of the money unit. So the fact that the S&P's gone up, like if you go back to 20, 25 years, pick the same month, November, S&P's gone up, what? As much as the money growth. It really hasn't beat the money growth, M2 growth. Gold's beat it handily. Nobody acknowledges that. Yeah, there's ups and downs, but the issue is to protect yourself from the con game of that piece of paper or the euro or the yen, same story. And now we have a government debt crisis in the UK, in Japan, here, when the Fed has to say, we're going to step in and buy the bonds. Oh, it's only because of liquidity. No, it's not. The market is in trouble. And if it starts down, the world ends. It's bigger than the stock market. It starts down, the upper yields. And we're watching the T-bonds very closely, and they're not far above levels, which if they roll over again, this time it's going to be a headline type story. And it's too big for the stock market to ignore. It's the kind of thing that'll derail every assumption you've got about the stock market. And do what? Cause the central bank to go ape. That's blood for gold. Gold's ongoing trend is to keep its value. It always does. Decaying money over decades, no problem. Gold holds its value. Very little else does. And that's what's really going on here in the big picture.
What will it take for the everyday retail investor to normalize these new prices? It seems that they're still having a hard time, normalizing the current prices of gold, and then even seeing it go to 8,000.
Yeah.
And how does that impact?
They have to measure it against the money unit would be one good way. Like if you go back and factor out the time spent since the 1980 high in silver at $50, the 2011 high at $50, and count the number of years and count the degradation in the money supply, the increase in M2, and factor that in and say, where should silver now be to factor out that compression it's been under to keep it not up to date with monetary degradation? $200, $300, easily, just to match those highs. And while gold has ongoingly kept pace, the stock market's only kept horizontal with that money growth. So it really hasn't made money in a real sense of the word. Where the number of loaves of bread you could buy back in November of 2000 versus right now is probably about the same number of loaves because the price has gone up a loaf of bread or a pound of copper. Get the point. So it's a money degradation issue, and ultimately that doesn't continue. Ultimately, that creates a crisis where fiat currencies get into doubt. And I think what will cause that is this economic downturn. And whenever the S&P and the stock market turns down, that's when the data points really go dark. And that's when the central bank does what? Cut rates, print money. It doesn't help the stock market, though. They did that in 2000 to 2002, 2007 to 2009. They went crazy on that. Didn't help the stock market. Did help gold. Anyway, that's where we are. And these factors, I think, are coming into play and soon. Bitcoin is already engaged, as far as I'm concerned, in a negative way.
I appreciate that answer, Michael. And I want to ask a question. If you were to educate right now the next generation. So let's say Gen Zs.
Mhm.
What would you want to teach them right now so they could better understand the market, so they could see things more
Yeah.
clearly?
Don't just look at don't just look at the dollar price. Factor in the reality that nobody does. That the money unit, your yardstick is plastic. Okay. You know, it, it's 12 inches one year, foot long one year, foot long the next year, but it really isn't. It's degraded. Your yardstick is false. It's not telling you the truth about the real value of something. Gold always maintains its value. So from an investment grade point of view, regardless of the ups and downs, gold is always a place to be for 10, 20, 30 years. Okay. Right now, we also argue that it's on the cusp of something very dramatic. But there's another broader issue that they might consider. Not only is it time to move into monetary metals out of the stock market, but there's certain components of the stock market you should look at favorable. The commodity complex is very, very cheap relative to its own historic prices. It's exceptionally cheap. I mean, like historically cheap compared to stock market. So, in other words, it's as if things that are real don't matter anymore. We ran a spread showing the Bloomberg Commodity Index versus the S&P going back decades. And you would think, my God, ever since the collapse in 2015 and most commodities came down along with gold, even through 2020, because the Bloomberg kept going down for the next 5 years, even though gold doubled. But you look at that spread and it's now starting to level off to where commodities are no longer losing value, but they're just not going up. But the level that they're at is like a stock was 100, now it's 2. Either it's going out of business or it's a buy. I mean, commodities aren't going out of business. Okay. So we're suggesting, and there's technical reasons, even a minor uptick in the relative performance of the commodity basket versus the S&P, which is likely to be a function both of the Bloomberg turning up, which we get a breakout in October in our assessment for a next up leg, and the stock market turning down in combination. That spread's going to move. And it's got a long way to go just to even get to modest reality. Meaning over the span of a decade, probably the commodity arena is going to be the new home for money, and stocks that produce fertilizer, create products related to agriculture, base mining, oil, natural gas, all these things are suddenly going to wake up as the stock market goes down. And they don't correlate well to the stock market. You can look at some of these sector ETFs in the commodity area. They don't go up and down with the stock market. So if the stock market goes down, don't expect them to. They can go opposite. And the Bloomberg Commodity Index, just for an example, is right now trading 109. In 2008, it was 238. In 2011, it was 170 something. And we're at 109, less than half the price of 2008. And yet people say, oh, commodity prices are too high. You haven't even begun to see it yet. Okay. And we argue that on a net basis, Bloomberg, which had been sideways for the last couple of years, Bloomberg Commodity Index, it had a breakout as of the October close, just above 106.50. We've since gone up toward 111. Right now we're trading about 109. And a lot of the components within the Bloomberg are also agreeing with that. Natural gas, grains, a lot of other base metals. So I think commodities are about to be a place if you want to invest. And if you get burnt in your crypto trade, cash out before you lose it all and put it in something that's basement cheap and has a reality. And it could be a cultural thing too, where people suddenly fall in love again with that which is below their feet, as opposed to concepts they can't even understand. Farmland, grains, copper out of the ground, silver, gold, things that are real and are undervalued. Anyway, that's a reality that the new generation should start to think about, put themselves back in their granddad's day. Okay. Anyway, that's coming.
There's definitely been some good pros in terms of the crypto space, in terms of investors learning more about the financial system, like in terms of the truth, right? Printing and inflation. So I'm curious, like, do you feel for the next decade while there's this super cycle that's in play for commodities, do you feel that this next generation, because of maybe the tension of crypto, do you think that they will be more maybe educated to make
Yeah.
this transition faster than ever?
Yes. Yeah, I think they'll learn the hard way, though, unfortunately. I've heard so many stories, and you know about them too, where, some kid that's 20 years old is a billionaire now or something, and he thinks it's easy. They just keep buying the dips. Well, our argument is technically long-term momentum factors said breaking below 108 like a month ago blew out a multi-year structure on momentum. Can't see it on price. Getting down over below the 101,390 level, $101,390, blew another massive structure going back years. Now suddenly you're starting to see some stuff on the price chart in the 95,000s. And I think this breakdown, and by the way, when we've shown this before in reports, and I'm not arguing it has to be the same fast outcome. The Bitcoin quarterly momentum chart going back a handful of years, you could overlay it on the S&P 500's quarterly momentum chart prior to the 1987 crash. You could lay one on top of the other, and you couldn't tell the difference. And when S&P broke that quarterly momentum structure in 87, like in the first week or so, it immediately crashed. Now, I'm not arguing when you break the structure this time, you must crash, but it's too coincidental to us that the structure is that malevolent. It says you just blew the bridge out from under the bridge over the River Kwai. All the beams are gone. Okay. The only question is how fast you're going down. It could be fast because of the margin and leverage. We know that. But I'm not going to argue that must occur. I'm just going to say probably quickly you're going to take Bitcoin, cut it in half, which is going to effectively destroy that market. Because you take out 4 years of longs and wipe them out. Okay. They're going to look for somewhere else, assuming they get their money out in time. And their buddy down the street that they laughed at bought gold, said, I don't believe in the Bitcoin gold thing. By the way, when you run a spread of gold versus Bitcoin, Bitcoin's breaking a major structure right now on the strip to the downside. So even that spread is saying, sell Bitcoin, buy gold. A lot of stuff going on.
You've seen so many cycles. I know you've seen booms, busts, and bubbles. What's one truth about the market that never changes no matter the era?
Well, you get the bust when you create excess. And usually the excess is sponsored by the central bank by printing a lot of money. And sure enough, you wait about a year or two, stock market goes up. And then when the stock market reaches excess and it turns down, then the data points start to turn south. Then the Fed starts to do what? Print money again. Not that they have ceased, but more, print more, cut rates sharply. It doesn't work. So I'm betting this time the crisis is going to be far bigger, and it's going to be in areas that are so huge and dramatic that aren't just the AI stocks, but they're going to be in certain key financial stocks that you get ambushed by, the financial sector in general, crypto. All kinds of assumptions are going to get cracked, fractured, and blown out the window. And people are going to then be tabula rasa. What do I do? What's real? And they're just going to continue to see that over there, that's working. Gold, silver, gold miners. Forget the day-to-day action also. Quit looking at day-to-day silver, day-to-day gold. Look at the bigger picture, especially our spread charts, gold, S&P, silver versus gold. When those beasts break out, it's just beginning. And I think that's in part probably going to be timed fairly well with what we're seeing now this month. Crypto's breaking trend. Won't take much to break the entire financial sector through structures. So all of a sudden, all these things could tend to be coincidental, in which case things speed up. And that creates fear. And sometimes when you create fear, pardon me for getting political, I'm one of the fathers of the concept of anarcho-capitalism. I wrote a book on it 1972-3. I published it in 13. Sort of acknowledges the first thesis building of concept of anarcho-capitalism. President of Argentina, elected 2 years ago, declared himself an anarcho-capitalist. Argentina has been in decay for decades and decades. It used to be the 7th biggest economy in the world. but two political party establishment parties, both socialist effectively, decayed the country. You had hyperinflation, you had high unemployment, you had rent costs through the roof, even though they had rent control, government did. Javier Milei came in, started chopping the heck out of stuff, removed the rent control the government had done. Suddenly rent prices came down. Inflation started to come down. But what happened to cause that? Because he was like a nobody. He's an intellectual, not a partisan type guy. Young voters, talking about, let's say, current crypto investors, okay? Young voters just said, I'm sick and tired of this. I hear these stories from my mom and dad, my granddad. Things are getting worse by decade. It doesn't matter who's in charge. We need something new. So it was hands in the air type of attitude. And no, they didn't understand exactly what Javier Milei, when he meant anarcho-capitalism, which of course you don't achieve overnight. It might take decades, meaning reduce, it's set to infinity government. But they voted for him. And he beat both parties, crippled them. And now we just had an off-year election where it was a congressional vote to see if he could get support or not. And wow, they won big too, meaning it was a reinforcement vote for Javier. So this is what happens when things like we're talking about in the Western markets occurs. People throw their hands in the air. And my 401k, I can't retire now. I got to work at Walmart. My wife just got laid off. Oh no, my electric bill keeps going up. Food price, Bloomberg takes off and suddenly grain prices go up again. Meat prices are high. They've been high well before recently, by the way. And they get pain on all sides. And therefore desperation sets in. And it wouldn't shock me. We know the Democrat Party has been fragmented to where they're either going hard left or trying to go moderate. They don't know which. Who knows? They may fragment into two parties. That's effectively what they are right now anyway. And even the GOP is fragmenting. It used to be the Trump party. Prior to that was the old conservatives like Barry Goldwater, Ronald Reagan party. Then it became the Trump party. And now even his people are fragmenting over various issues, sharply fragmenting with him. And if you go into an economic downturn, the public support for him is going to collapse even more. So the GOP could go into fragmentation. Aha. You have an Argentina-type situation where it's hands in the air. In other words, total, not just market decline, but hands in the air view about institutions, concepts. Do we really need the Fed? I can't pay my taxes, and nor can 25% of the other taxpayers. So maybe the IRS doesn't function anymore as a source of revenue for the government. And so the government has to say, we got to find an alternative because, we got non-filers are up to the roof right now this year, 2025, let's say. Go to sales tax. All kinds of things could change. So your notion of what's reality could change drastically. And I'm suspecting that's the kind of cycle we're in now. Something mega, not normal. We'll see.
I appreciate that answer, Michael. And something that I've said before on the show is Eric Sprott talks about you a lot. He really, really respects your voice. And something that I enjoy doing is having a tribe of mentors, people that I can learn from, people that I trust. And you're one of them for me. A question I want to ask is, who are your tribe of mentors? Who are mentors that are either still living today?
I got out of political philosophy in the 1970s and joined E.F. Hutton in April of 75, a couple of months after gold was legalized. And I moved up to New York. They were in Battery Park, their headquarters, Commodity Division. And I was trained under a guy named David Johnston, who was also chairman of the COMEX at that time, head of Hutton's Commodity Division, which then was the second biggest commodity firm in the world, and chairman of the COMEX. And he was chairman of the COMEX also up through 1980 when the Bunker Hunt crisis hit. Anyway, so I learned a lot from him, but he was just a simple price chart technician. I later evolved into momentum analysis in the 80s, and I caught the crash in 87. And in 92, I set up MSA. So I would say to some extent he was a mentor. My main mentors are people I only met for a while. I knew Murray Rothbard well, Dr. Murray Rothbard, who's now considered, he died in the 1990s, the father of libertarianism, and we moderately know it. I knew him well back in the early 70s before most people even knew who he was. And he communicated with me. And when I wrote my thesis, which was on anarcho-capitalism, I told him I was going to publish it as a book that I had permission to quote him. And he said, absolutely, yours will be the first. Okay. That was great. And then I met Ayn Rand one time. We lived a couple blocks from her in New York City when I was at Hutton. I knew she lived in the neighborhood, but one day we were crossing the street. My wife worked in the Empire State Building. Pardon the personal stories. You ask a question. Those are the two intellectual mentors I have: is Ayn Rand, her basic philosophy, and what I did is I lobotomized her politics. She had basic core principles of philosophy, and her political views were basically founding father limited government type stuff. I chopped that off and put Murray Rothbard's radical libertarianism as the political economic part of that pyramid of ideas and put them together into anarcho-capitalism. Fortunately, I was able to meet Ayn Rand for all of about 120 seconds. My wife and I chatted with her on a street corner. She had her secretary and her husband with her. And my wife happened to recognize not Rand, but her husband, who looked like a Gary Cooper type figure, big tall guy. And it was like a block from the Empire State. We went over and said hello. She was a great woman. She and Rothbard also had been together for a while in terms of intellectual, and then they broke up. Rand kicked him out. She was a rather staunch woman in certain regards. But anyway, those are my mentors. I have very few, okay? And I love the fact that Eric Sprott likes her work. He's the king of silver, and I think he's rightly so. Yeah. Anyway, good talking to you.
Yeah, no, I appreciate that answer. And I just want to take this last little bit of time here, Michael, to, thank you for being here today. Thank you for your time. And is there anything else that you want to add before we sign off?
No, just to, encourage your listeners to maybe check in on our reports at olivermsa.com. You can see what our unorthodox methodology is. We explain it fairly well. It's not normal technical stuff. We've been doing it for over 30 years. It used to be only for institutions, and then in 2015, we opened up to regular subscribers. We focus on all major asset categories, but especially stock market and commodities and gold and silver, with emphasis there. But there's a lot of stuff going on in some of these other markets that is too major to ignore, like T-bonds. So that's what we look at and give you a full view out the window, not just looking out the narrow window at gold, but the broader view.
Yeah, and I appreciate your time, Michael.
Thanks, Ben.